Welcome back to Rockstock Channel. It is Friday, May 9th, and we are excited to have back for the second time Ana Cabral Gardner, CEO of Sigma Lithium. I just looked back at our last video and was shocked that it was nearly 1 year ago, last May, after Sigma's Q1 earnings results. Sigma is listed on both the NASDAQ and the Toronto Stock Exchange, same ticker symbol SGML. It is a spodumene producer in its second year of production and one of the very few companies that have executed on time, on budget, with very strong operational metrics we'll speak about today. Sigma will be reporting first quarter results next week, May 14th, and we recommend those interested to visit Sigma's website, sigmalithiumresources.com, and register to hear that call and also to join Sigma's email list. Sigma pre-announced last night another quarter of positive adjusted EBITDA of $11.4 million, with production and revenue 26 and 28% higher than Q1 2024. Adjusted EBITDA of 24% margins is impressive considering the current weak spodumene and lithium chemical price market. Ana just returned from the Milken Institute Conference, so we're looking forward to digging into that and other topics in a moment. For disclosure purposes, RK Equity is an advisor to Sigma. I invested in the company for the first time a year ago after listening to Ana's Q1 earnings call. Having come down from $7 to $17 from $41 a year prior, I thought I was getting a bargain. But alas, in hindsight, I ended up buying at a 52-week high, and SGML today, at about $7.50 a share, is near its 52-week low. Still, in Canadian dollar terms, the stock is $10, which is 5 times higher than the IPO price of $2 when I met Ana in 2018. The stock is also 5 times higher than the COVID low on March 22, 2022, a table of which will flash on the screen and was included in my latest Lithium-ion bull note published yesterday. You could find this issue on my LinkedIn profile on X at Lithium-ion Bull. And if you're not already on the email list for this publication, please visit rkequity.com and register your email. SGML market cap is about $850 million, and it's covered by 4 sell-side analysts at Bank of America, BMO, Canaccord, and Cormark. If you have interest in this research or would like to get connected with Sigma's IR team, please email us at rockstockchannel@rkequity.com and we can connect you. And with that, welcome, Ana. We'll ask some questions about the Milken Institute later, but first, Rodney has a bunch of questions since our last interview last year.
And if you could, can you please give our audience a quick refresher on the Grota de Cirilo project and outline the location, size, and grade of the resource?
Grota do Cirilo is the 5th largest lithium industrial mineral complex in the world. The size is significant. I mean, it's the 5th largest hard rock in scale and in size, which means the 4 projects in operation ahead of it are located in Australia. Grota do Cirilo now has over 110 million tons of 43101 audited mineral resources, 77 million tons of reserves, and over 150 million tons of 43101 estimated resources. Just putting in perspective, with our current plant 1, that would be 66 years of operation. With plant 2, that will be over 25 years of operation. And that's kind of how we keep it. When you look at it from the reserves perspective, it always allows us to have what we call the visible cash flow of reserves. The mineralogy, the grades, the overall geology is spectacular, which allows us to operate probably one of the most technologically efficient dense media separation plants in the world. We are reaching about 70% recovery at plant level, over 60% of global recovery when you think about back-to-back process recovery, nearing 18% yields when you think about raw patch product. And that's in great part enabled by the mineralogy of large crystals and high purity, which we honored in the way we developed the technology for the dense media separation plant. The grade is on average 1.7% of lithium oxide. And again, it's located in the northeast part of Minas Gerais state in Brazil, in the Lithium Valley. So it's a privileged location because it's an industrial state, which means we have access to, wide roads, asphalted roads, access directly to port infrastructure. We're connected to the grid, high voltage clean electricity grid, inexpensive green power, abundant water. We use sewage water in our process, so closed process using sewage water. It's a fantastic location, a low-cost jurisdiction. It's a spectacular resource, and we honored all of it with what we call state-of-the-art lithium processing technology.
Great. And I was going to mention your Q4 2024 results, but you gave some indications of what's to come in Q1. Can you give us some of the key metrics on output and cost and what the main highlights are going to be?
Yeah, no, we continue to execute on track. Once we hit the stride, we just gonna hit every target we set out for ourselves. We produced 68,300 tons, which is basically above the target. But more important, Howard talked about on my podcast last year, it's 26% increase from last year, which just corroborates our ascendant trajectory as a company. We've been outpacing ourselves, and we are on an upward trajectory in execution. We haven't even reached the second year milestone as a producer, and we keep on beating our own targets. Still on the first quarter, another highlight is the downtrending of our costs. So we continue to find cost improvements opportunities. So we are now at plant gate delivering a $350 a ton cost, which is slightly better than our targets, 5% better, but it's 12% lower than the first quarter. So essentially, it's a clear downtrending of cost, clear optimization towards more efficiency. And then you bring that to the gate, to the we call port CIF gate in China, and that's 17% better than the first Q, 10% better than the targets. And then if you bundle all-in sustaining costs, which includes maintenance capex, includes interest, royalties, all of our cash SG&A, all of our cash costs. So the total cash cost for us to be in operation, that's $622, which again is 20% lower than a year ago and is 7% lower than the target. So we keep on outpacing ourselves, constantly finding new opportunities for even further cost reductions. So think about that. We sit here as the second lowest cost producer in the world as hard rock lithium producers, second only to Greenbushes. And we're still finding cost opportunities, cost optimization, mostly on the industrial operations, by basically increasing the efficiency of our plant.
Okay, excellent. And I noticed you had a good, in Q4, certainly you had strong sales price relative to the market? How are Sigma's commercial terms looking going forward?
It's basically the market prices are what they are. We have a client that I much admire, Xiaosheng, who basically said that FS markets recently. Market prices are market prices. We have to deal with market prices. So what we try to do is to focus on what we can control, and at that, we be reaching sales prices between 850 and 900, which were, the first quarter is low season, right? Which were the low season average. But more importantly, we were able to generate EBITDA, adjusted EBITDA of $11.5 million, which is essentially a 94% increase over last year. So it just shows what this company has become in just a year, and is in line with the fourth quarter where we had higher volumes. So we basically hit the stride of cash generation that demonstrates the resilience of this business to the current low point in the lithium price cycle. So we are resilient because we're low cost producers, because we are efficient. So and that is ongoing, meaning being resilient is a constant exercise. Another element I like to quote on that is, cost cutting is like clipping your nails. I mean, you have to do it all the time. It's a constant exercise of how can I be better? How can I be more efficient? What can I do better? Right. And it's not often just slashing costs. Sometimes it is just improving process efficiency that enable us to lower costs as a result.
Okay, excellent. And I saw that Plant 2 construction is underway. It appears to be on track. When is that due for completion and commissioning?
Yeah, we're looking to complete that this year. And I think going back to continuing to prudently, conservatively, and responsibly advance on our plans of building the growth is the motto here. We obtained $100 million of heavily subsidized government debt. That's 16-year uh, uh, duration at 2% in US dollars. So it's the best kind of debt because it's debt, but we got 16 years to pay. Just to put in perspective, in the first uh, 3 years, we would need to pay a PMT would need to be roughly uh, $25 million. So essentially, to borrow $100 million, we would have to pay total of $5 million on the first 3 years, which means it's got an 18-month grace period, very low PMT, so very manageable repayment schedule. So that's kind of the cornerstone of how we're planning to deliver on our growth, and we go at the pace of that government subsidized line. So essentially, in our view, that will be the one manner through which a company like ours could responsibly grow its operations and continue on building a second plant, an expansion, right? And again, we do have this 24% EBITDA cash margin. So we are generating operating profit, and it's there. Um, but we believe that the combination of, the profit that we generate, which is there, is a safeguard, and the government that basically enables us to continue to draw from and to continue on our construction, is the pace at which we go about our expansion.
And with everything on track, Anna, what are your targets for production output for 2025 and 2026?
Well, with the second plant, we're giving out a 520,000 ton target for next year. ultimately the concept will be the plant will start and will run at what we call the design capacity, which is 250,000 tons. So that anything we do better than that is just a bonus. But what we're giving out is at design capacity, this plant runs at 250,000 tons. And again, when we look at our targets for this year, which we are reaching, they are 270,000 tons of lithium oxide with spodumene concentrate. So when you add both, we would end up with 520,000 tons for the year. That lowers our costs further. But again, at the current cost position that we are, the key driver there is essentially increasing the efficiency on scale. So you will have a much more important uh, 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 lowering of cost. You have a much more important impact in lowering the total all-in operating sustaining costs, because we're currently projecting to have about $80 a ton in interest per ton payments. And once we have the second plant volumes, that get cut in half. The same happens with SGNA, because now we got a corporation that's built for a dual plant, given that we have the project teams in place. So when you think about our SGNA, we're targeting $55 a ton for the 2026 period, because that would also have immediately, I mean, you don't need two Anas, for example, to run two plants. So that kind of gives you a dimension. So we become much more competitive on all-in sustaining costs. So that is where we really have the bigger gain. So when you think about what would be the all-in sustaining cost with the second plant, that would drop to $530 a ton from the current $668, $670 a ton that we guide, even though, as we demonstrated in Q1, we are getting to numbers at 622, which are below guidance. So, but we can do even better. So imagine comparing first quarter $622 of all-in sustaining costs, everything in, and then next year with another plant, this number could potentially be 530. So we can go even lower in cost, which is just, I don't want to rattle all these numbers. I think it's just quantitative data points to show how resilient this business is. The level of efficiency that we've reached that allow us to be resilient to market prices, which are what they are, right?
Yeah, I mean, that's a great point. And in the sense that I can't think of, there are not many businesses in this market environment that can grow and do it profitably. So it certainly is hugely helpful with the loan and as you say, expanding and then dividing with greater number of tonnage to lower that cost. So if we can move on to, you don't have an agreed upon offtake arrangement. So what is your current thinking around staying flexible given market conditions?
Well, we do plan. We're now going along the lines of signing what we call the dual, right? Offtake plus prepayment. We are actively engaged in discussions with our clients on that front. That's another corporate finance project that we are spearheading here. There are a number of interesting solutions that have been presented to us. The clients are the clients, and essentially we would offtake the product for. There are different scenarios, but the most basic scenario here is that we would offtake the product for 3 to 4 years against a prepayment. So, number of discussions going on. That's one of the exciting things we've been looking to accomplish in the North American summer. And again, we're going to have quite a lot of volumes very soon. We already have a sizable volume. We together with Mineral Resources represent a good significant portion of the traceable, sustainable spot lithium concentrate market. So when you double that, it's kind of keeping the balance, right? We'll maintain part of our production sold through spot because that would be the market check on the prices. And then we're looking to diversify from that commercial strategy by signing offtake agreements against prepayments. And we're very excited about the caliber of discussions we've been engaging in on that front.
And tying into that, Anna, do you see the geopolitical conditions in the lithium world being favorable for Sigma?
Oh yeah, no, absolutely. Sigma is a friendly company, and we're fortunate to be located in Brazil. I think what we most admire about where we are is the fact that uh, we operate in a investor friendly, in a diplomatically neutral environment, which in a manner gives us uh, somewhat of a neutrality in the midst of what's going on. So we're friendly with all sides of the table. We supply the world. Brazil is a BRIC leader, is also a very friendly country to the United States, is friendly to China. So that helped us the neutrality of Brazil helped insulate the company in so many ways from these global trade disruptions and in general from the overall geopolitical tensions. So we deliver lithium oxide material to all markets. And so that actually also increases our resilience because when you think about the kinds of offtakes against prepayments Sigma Brazil can undertake, it's the world is our oyster. So we have a diversity of conversations that's quite unique, and it shows it's a demonstration of who we are in Brazil. We talk to everyone, we trade with everyone, we're friendly with everyone, and that increases our commercial opportunities significantly.
Right. Howard?
Yeah, can I just dig in a little bit to the offtake? Yep. And the prepayment, from a corporate finance point of view, because every prepayment has some embedded interest rate in that. And your Brazilian loan, I was just listening to that 2%, and I just wrote up on Lithium Americas. They got U.S. Treasuries, at 4.8%, right? So you're doing better. That's like the lowest lending rate, that I've seen. I know that Albemarle just did a $350 million prepayment they announced in their Q1, but there's always an embedded interest rate, right, in any kind of prepayment. So the flip side of that, theoretically should be you're getting a better price if you're locking long term. So can you just, I guess, walk through the logic of signing a long-term offtake with prepayment? Do you need to do that? Do you need the money up front, or why couldn't you just continue to be selling at spot with hope for, sky's the limit pricing if these customers are going to be, just desperate for your product in the not too distant future?
No, you made an excellent point. I mean, we're not dealing with caps and floors here. That's actually a key point to make it clear. So when we look, and this is the reason why we haven't done a single prepayment completely against industry norm to date. Imagine we're a 12-year company. We built this, and we have 100% of our units uncommitted. Then we go from 270 to 520. And that's kind of the context within which we rethought our commercial strategy. I mean, to sell 520,000 tons of material 100% on spot could create volatility because we would need to navigate seasonality next year to achieve the kind of prices we are achieving with double the volume. Can it be done? Yes, it can. Are we better off doing that with a joint trading company commercial partner? Absolutely, yes. So this is the context of the prepayment, is essentially selling market prices because, to your point, we don't need a floor. So who doesn't need a floor doesn't get a cap, right? Caps and floors only exist as pairs. None of that. But then that would give us visibility on, okay, this volume, which we're not looking to go over a certain percentage of our production. We're still, for now, leaving 2/3 uncommitted for now. This volume will be directed to this part of the world, and that will give us, let's say, certainty of navigation on seasonality. We're scheduling shipments to periods when we believe seasonality is positive, and it will be an attempt to do something we never done, which is the prepayment. Second question, do we need the money? No, we don't. But then we have debt that is due in December 26, 2 years from now. So and that debt was incurred upon when we were pre-producers. So that debt costs me 13% a year. It's expensive for who I am today, generating EBITDA, generating cash. So when you think about prepayment coming at around SOFR plus 3.8, 3%, it's a nice way of doing liability management, of locking in visibility of shipment schedules at market prices, whatever they are, which we are comfortable with. Up, down, we're good with the market. We are comfortable with market prices. So this is an excellent question, because it kind of helps me contextualize why would we be doing. But more importantly, it helps me start directing volumes in an operation that very soon will be double my scale. And then when I look at the peers I admire that have these large volumes, to your point, all of them have prepayments, offtakes. They have product committed. Some of them don't have any free product until 2027. So there's a flip side to being leaders in a spot market, which is the price is actually what we make. So when you look at spot prices, we can't even benchmark from those prices because it's at whichever price we sell, given the volumes. So we want to start diversifying further our commercial strategy through prepayments, through set customer agreements.
Okay, thank you. That was a lot of great color to that question. You mentioned Shaoshen is saying kind of the price is the price. This is a hard question to answer, but last quarter everyone thought 800 spodumene. No, hardly anyone was making money. The price couldn't go lower, and here, like the past month, the price keeps drifting down. Do you have any color, pricing wise, what's happening? Are inventories being drawn down in China, or is China supply, what's going on? Because the demand side looks pretty good out of, China, Europe, and elsewhere. So any market commentary you can give, supply, demand, price, would be greatly helpful.
Absolutely. Well, clearly you have demand being very robust, very strong. The numbers you can see, I mean, I give you numbers, right? When you look at EV growth, February, January in China, which is the largest market, you're hitting a pace of growth that is a stride that's higher than it's ever been. So we're now looking at, and I'll give you the exact numbers here. We're looking at EV demand growth in terms of thousands of EVs that in January hit 1 million cars, and then in February was just 890,000 cars, and January it was 944,000 cars. This is way higher than January of 2024, where you had 730,000 cars. So we've gone from 730 to 944,000 cars in 1 month. That's January. And then in February, which is typically low season month, we gone from let me just look at the numbers exactly here. We gone to from 500 to 892. So it's mind-boggling, right? When you think about EV growth pace in China. Then you have storage in China because of the renewable buildup. So the domestic ESS story is also very robust. So, and I just gave you growth for EVs, which is just one destination for batteries. Even in Western nations, we've been observing things such as data centers selecting states that can provide them where the distribution company or generation company can provide the state with a renewable project, and then the utilities going to trading companies to seek hedging for the materials in the battery so that they can lock in the cost of these stationary batteries that would bridge the intermittency gap between wind and solar and what have you. So a lot of very interesting things have been appearing in the market in terms of inbounds from customers, usually through trading companies. Again, another data point, in China, we met 15 new trading companies. They're being solely engaged. They're based in Singapore, solely engaged in providing hedging solutions for utilities on ESS buildup. And these numbers are not even mapped out on demand. So I just gave you a lot of color to quantify the growth of demand. So it is not a demand issue. So I'll pause. Now, what happens with supply? Well, that is the main question. You have inventories there that were built during the frenzy of price increases of 22, 23. These inventories were financed by the shadow banking system, and a lot of these refineries and participants of the midstream that have smaller balance sheets that were still sitting in inventories. Obviously, when the prices increase a bit, they try to monetize their inventories to basically cash in on some of that, some of those assets, that asset base that they built, and during times when the prices or actually sometimes even higher, is a way for them to offload their balance sheets of inventories built during that price escalation. So, and it's more difficult for us to ascertain. Fast Markets does a very good job, and Benchmark as well, of trying to track inventory. We call the downdraft levels, right? And that is key to understanding prices. It isn't demand weakness. Demand has actually been more robust than I've ever seen in these years, in all my years in lithium. Then you have supply, which is there, but then you have this inventory, which is the extra supply, which still needs to be brought down so that prices start reflecting better the robustness of demand. So for now, what we are going to see, and that's consensus, is we believe an average price of $900 for the year. We're still seeing that, perhaps reaching slightly higher levels during the seasons of the spring and the fall season. We're yet to see the beginning of the spring season because of the May Day, V-Day holidays, May Day, Labor Day, Victory Day holidays, which will end this coming week. And there are very little volumes in the spot markets being negotiated. So the prices, as I told you, they're not indicative because the volumes are tiny, at least for our part of the business, which is the lithium oxide. So we'll see what happens post-holiday into season, into May full swing season, June full swing season, July, end of season. So that will be very indicative of these kind of consensus predictions of 900-ish throughout the year, averaging out these levels. So that's why we say market prices are market prices, and one needs to do well with the status quo so that when prices get a little bit better, all you got is excess returns. That's when you achieve your excess returns versus breaking even. So we are in very positive territory now. We've shown 24% EBITDA margins. We have a very competitive all-in sustaining cost, so that when that extra, rebound happens, whatever that is, 950, 1,000, it all becomes excess return. So that's why we're so relaxed, because we're doing well in the low point in the pricing environment.
You're very well positioned, and when prices rise, you're very substantially leveraged to those higher prices. But you're active in the market, in the spot market, and it's a big conundrum. Fast markets may do a good job, benchmark may do a good job, but we get the price every day, and we think if Albemarle saying 40% of the industry is losing money, why prices keep coming down. So where is it subsidized supply out of China? I know CATL turned back on their lepidolite mine, but is there surprise supply that is out there that we don't see beyond the inventory drawdown? So you were just at the Milken Institute. Where was that?
It was in California, in Los Angeles.
Okay. I spoke earlier this year to Ken Hoffman, and you were at the Riyadh Future Summit, in January, and then he said he was, then did a presentation, in Nevada, and he said it was a tale of two cities, super optimism, in the Middle East, super pessimism, in the U.S., and that was true, I think, also in Canada and Australia, et cetera. So anyway, what were the takeaways? That was a few months ago. What were the takeaways now at the Milken conference? And do you see a dichotomy between kind of optimism and pessimism, in these different geographies? Because the debt that you're talking about needing to refinance, I think, comes from the Middle East,
Oh,
if I'm
yeah.
not correct.
And it's from a shareholder. So it's the most benign form of debt can have. And again, it's 2 years from now. So we're totally relaxed, right? And our shareholder, actually, he would love to stay as our creditor because he told us, well, we lent to you when you had no revenues. Now that you have EBITDA, you keep on paying me 13%. I'm happy. Essentially, it's a group. We have a very good group of core people here, and that shareholder is Synergy. Is a large private equity fund run by a former senior executive at the Mittal family office. And it's interesting because forward to Milken, I was sitting with another Mittal family member, and the conversation was about the energy transition. The Milken typically brings in what we call the big conversations, and then it brings different participants of the conversation. So it was fascinating because I was sitting at a panel with Mittal, with Amos Hochstein, who used to be President Biden's special energy advisor, with the chairman of Aqua Power. Aqua Power is the families behind it were some of the earliest investors of Sigma. Is the seventh largest private group in the whole of Middle East. Aqua Power is the largest renewables company in the Middle East. It's a $65 billion company. So the chairman was there, and then the chairman of Abu Dhabi's nuclear authority. So it was, and then it was moderated by basically Dan Yergin, who is a god in the energy industry. He's the gentleman who wrote Prize, that book. And he's the co-chair of the Global Energy Center at Columbia, of which I am part. So we all were friends and connected from our work and from our previous walks of life, right? And I met Amos when he was still in the White House, so I have an enormous admiration for him. So we all knew each other, and so the conversation was the bigger picture. To your point, energy transition. What are we transitioning into? What is this basket of power, meaning power sources, going to look like from oil, gas, nuclear, hydrogen, the critical materials through lithium-ion batteries, electrification? We are just a part of a bigger energy matrix, right? So I was there basically discussing my part in the biggest energy matrix, because even the conversation on nuclear kind of evolved given what is going on and what is actually the key driver. Ironically, as we grow as humanity, we need a lot more power. I mean, the power demand in the US has been skyrocketing as a result of the buildup of data centers for AI, which is the genie's out of the bottle there. We're not turning back from that trend. So those growth levels take place with the demand or with the ask from consumers, as I just said, for a renewable growth. So that's one consensus of the panel. That was a big takeaway. The growth in demand is a positive for stationary batteries because clients, the technology companies do not want to go backwards on their targets because they're plugging in data centers in coal-based grids. Second, we're going to need nuclear, a lot of nuclear. And the president of the Abu Dhabi Nuclear Authority was on the panel. Now, what I brought up was, well, has anybody been to a uranium mine? So, because what I brought up was a lot of what we talked here as far as power demand, energy transition, is connected to mining. And then we obviously had a very long conversation about responsible mining, traceability. And I mean basic things like helmets, EPI, health and safety. Are we creating a one giant artisanal pit to feed certain parts of the energy transition? Well, that would not be conducive to a proper energy transition because it would then mean we're transitioning back, given that oil and gas, which is the status quo, had pretty high health and safety overall human standards in the way they conducted themselves. So I think the conversation was really, really interesting because we touched across all of the points. And the conclusion was we're going to need all sources of power we can possibly tap in. Probably the last oil to be turned off will be the low carbon oil, the kind of Saudi, Middle East, Brazil produce. Even oil is part of the mix for the next 20 years because humanity needs a lot of power. And it was fascinating because that just washes completely the thematic that the energy transition will not go forward or electrification will not go forward for demand issues. Quite the contrary, demand is surprising on the upside.
Okay, great. Really appreciate the color on that, and there's more to dig into over time. The dichotomy of Saudi Arabia being the most oily, country in the world, and they're on the cover of The Economist this week. But nevertheless, they have a 2050 objective to be half renewables.
And Aqua Power is a big part of that. Aqua Power is the company, right? Aqua Power is just pushing them forward. Yeah.
So the dichotomy of that, I would love to hear Trump and his administration, with similar targets for renewables here in the U.S., but I haven't heard that yet. But final question, just on valuations and how you think about things. Your presentations in the past often compare yourselves to Pilbara, which has made an acquisition in Brazil, and that stock has gone down like all stocks have gone down. But you said you're the lowest cost relative to Greenbushes. How should I haven't actually done a comparable analysis of it, but overall, I think you have put Brazil on the map, and we have a lot of viewers in Australia, and those Australian viewers may not know Sigma as a company as well as they know it, Pilbara, Liontown, IGO, et cetera. So yeah, how can we think about your 850 million market cap, your production level, your production cost, your cost of capital, relevant to that? Because Pilbara shareholders clearly should care about Brazil through the Latin Resources acquisition, and you could be a helpful, I guess, voice and insight, into what's happening there.
Absolutely. I mean, Pilbara is going to do extremely well in Brazil. It will be diversification for them because it is a low-cost jurisdiction. So we're great operators. They're great operators. So if you're a good operator in this country, you're going to do well. It's a mining country. So very mining friendly, rule of law, legal certainty, mining friendly country because this is a middle income country. So the people need these jobs. Communities welcome you. We just had a public hearing less than a month ago where 2,000 people came in massive, overwhelming support. 91% of the testimonials, and there were 60 of them, were positive. So it was something that has never been seen in this country. Why is it? Because we've been investing in our social license for years prior to earning revenue, and we continue to do so even though we are not profitable yet. So the shareholders haven't received a dividend. They hopefully will by the end of 26. But so far, all the operating profit generated, and we're generating EBITDA, robust EBITDA at that, 24% margins, gets reinvested. And part of that goes into social initiatives. We have about $30 a ton in ESG, and we are the second lowest cost producer. So it doesn't hurt us at all to deliver back to the community. So we're not lower than gray bushes. That's the golden standards because of their scale, right? They're taking out, above 2 million tons of lithium concentrate, I guess. But we, at our scale of 270, are the second lowest cost producer, which just demonstrates where we can head into once we continue to deliver the scale. And this is the Brazil formula because despite not having that scale, we are lower in cost and we are lower than everyone except for Greenbush. So that's why I'm saying Pilbara will do extremely well here because they're very good operators. We are obviously significantly undervalued, like pretty much most companies in our basket. But one point that's notable, and that's kind of sad, we're a Canadian company, operations in Brazil. We're listed in the US. And interestingly enough, um, sometimes we suffer from the US malaise because my peers in America are chemical producers, and the chemical industry is mostly in the red. We're not in the red. And the chemical industry is the midstream where you have more competitive pressure in Asia. Uh, we are we are in probably the last remaining portion of the supply chain where there's positive margins and there are, excess returns to be achieved, which is the what we call first degree industrialization, delivering lithium oxide. But the flip side of being listed in NASDAQ is that we end up pegged to chemical producers who have completely different business dynamics than us, capex and competition. So I think it's just a matter of keep on printing positive quarters. We believe in reporting numbers, right? So it's basically a company that hasn't been produced for 2 years, and we hit a stride in terms of production cadence. So it's just a matter of keep doing it. Remember, you had kids, right? The Nemo thing, just keep swimming in. Price of what they are. We're low cost producers. Just keep swimming. And it's kind of what China does. They just patient, resilient. They know where they stand. They keep building fortresses of competitive positions around their businesses, which is what we're doing with this efficiency obsession we have. Around costs, around increasing volume. So it's the dual, right? We lower costs, we increase volume. So much more efficient, never stops. We're pretty relentless and we keep swimming. And I think we're doing well as a result of it. There's this relentlessness that we have.
That's a great way to end it, Ana. Again, we have a lot of viewers in Australia who I think who may not who invest in Patriot, with Ken Brinsden, and I know there's a lot of shareholders of Q2 Metals. So the Aussies do play in Canadian and U.S. listed stocks, but I think we could be a little bit of a helpful bridge, to that kind of analysis with videos like this. Again, if anyone wants any research from one of your four analysts, please reach out to Rockstock channel at rkequity.com, and please tune in to Ana and first quarter results this May 14th. I think it's Thursday, and register your email or go to their website and register your email to get their press releases. Thanks very much, Ana. Great to see you again, and look
Thank
forward
you
to your
for
earnings call.
hosting me. It's a huge honor to be here again. It's great to see you 1 year later. It kind of puts that execution in perspective. 1 year later, we just keep getting better. Thank you for hosting me. It's a huge honor. You're
Yeah.
a rock star. You are the rock star. Yeah.
Okay. Thanks very much.